All right, let's talk about the financial qualification rules for long-term care Medicaid. Medicaid places limits on assets and income in order to qualify financially for the benefit. The rules limiting assets differ depending on the marital status of the applicant. An asset is anything available to the applicant that is convertible to cash to pay for goods and services. The qualification rules divide assets into categories of those that are accountable and those that are defined as protected for qualification purposes. Protected assets are not subject to the spin-down rules. Now, let's talk about the financial qualification rules for a Medicaid applicant that's unmarried. For an unmarried person, assets are limited to $2,000 unless they are of a type classified as protected. Unprotected assets above the $2,000 limit must be spent down. Certain types of assets are classified as protected and not subject to the spin-down requirement. These include the house, in most instances, all personal property, one car, insurance with a face amount of $15,000 or less, burial plots, and a prepaid funeral arrangement. Unprotected assets over the $2,000 limit are countable. Countable assets must be spent down to the required limit. Here's the magic. There are only two ways to do this: purchase goods and services or give the assets away. That's it. The general rule anticipates that countable assets will be spent down to the $2,000 limit by purchasing goods and services. Then the application is filed and finally approved. There are exceptions to this general rule that, when correctly applied, permit the gifting of assets as a means of spending down.